Choosing between investing in stocks or real estate can be a difficult decision, but understanding each option's advantages and disadvantages is key to helping you make the best choice. Stocks may offer higher potential returns with proper management, but real estate typically provides more stability, tax incentives, and the ability to utilize leverage. In today's video, we'll be exploring the key differences between stocks and real estate so that you can make an informed decision about which one is right for you. But before we start, make sure you like this video and subscribe to our channel for more awesome content. Barrier to entry. So let's start with the elephant in the room. The cost of investing in real estate is clearly higher when compared to stocks. Investing in real estate can be expensive due to high costs associated with purchasing a property. For example, if you were to purchase an investment property worth $300,000, you would typically need at least a 20% deposit. That's an upfront cost of $60,000 just for the property alone. Aside from the initial purchase price, investors must also factor in closing costs, taxes, insurance, and maintenance expenses. Stocks, however, require far less capital, since you can literally invest with as little as $5 thanks to online brokerages such as Robinhood. Investing in stocks can be an economical option, as you save money by not having to pay commission fees for buying and selling. Additionally, there are no upfront costs, allowing investors to take advantage of their funds more quickly. So, as far as capital investment is considered, stocks win easily over real estate with their low barrier of entry. Time commitment. The next thing to consider is the amount of time you will need to commit. Real estate investing can be an incredibly rewarding endeavor, but it also requires significant time, effort, and knowledge. Before investing in a property, prospective buyers should thoroughly research the local market to get a better understanding of the area and its potential for growth. This research could involve looking at recent sales activity for similar properties in the area to get an idea of what kind of return you might expect from your investment. Additionally, researching legal regulations related to owning and managing a property is important to ensure that you are aware of any potential pitfalls or restrictions. This can become quite time-consuming to learn, as it varies from state to state. For example, states such as Texas and Florida are a lot more landlord-friendly than California or Vermont. When investing in real estate, it's also essential to be prepared for the long-term commitment that comes with owning a property. Many investors choose to lease or rent out their properties, which requires additional time spent on management activities such as finding tenants, collecting rent payments, making repairs, and responding quickly to any maintenance needs that arise. It is worth noting, however, that once everything's up and running, you can outsource this work to a property manager. So what about stocks? Although stock investing generally takes less time than investing in real estate, it still requires careful consideration and understanding of the market before investing. Prospective investors need to evaluate different stocks and mutual funds based on their risk level and potential returns. The good news, though, is that if you do your research well in the beginning, you will be able to sit back and let your money grow passively. Warren Buffett has a great saying that goes something like this: if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. This is a great quote because it illustrates how the top investors think. You should always be investing with a long-term approach. Ask yourself, would you be happy to own this stock in 10 years' time? So, as far as time investment is concerned, stocks again have a slight edge over real estate and are for the most part a more passive form of investing. Liquidity. When it comes to comparing the liquidity of stock investing versus real estate investing, there are a few key distinctions. Real estate investments can often take months or even years before they can be sold or rented out. This significantly reduces their short-term liquidity potential compared to stocks, since profits or losses cannot be realized as quickly. Additionally, selling a property doesn't happen overnight and often requires extensive research into local laws and regulations before any transactions can occur. Buyers must also go through a number of steps in order to purchase the property, which takes time away from the actual trading process itself. When it comes to stocks, the liquidity is much higher due to their ability to be traded on public exchanges. This means that stocks can be bought and sold almost instantaneously, allowing for quick reaction times when market conditions change. Due to this, stock investors are able to effectively capitalize on short-term opportunities far better than real estate investors. If liquidity is important to you, then it's clear that stocks are the best choice because you can cash out your investments fast with only the click of a button. tax. When it comes to taxation, investing in real estate has several advantages. Not only can you benefit from deductions related to your investments, such as mortgage interest or property taxes, but you can also depreciate the value of the property over time, which can help lower your overall taxable income. This means that you can defer taxes and keep more of your income for other savings or investments. Additionally, real estate gains are often taxed at a lower rate than regular income, so you could be saving money in the long run. On the other hand, investing in stocks also offers its own tax benefits. Many types of accounts, such as an IRA or 401k, offer tax-free or lower-taxed investment opportunities. Long-term capital gains from stocks are often taxed at a lower rate than short-term gains as well, so if you buy and hold stocks for more than 1 year, then you could be eligible for better tax rates on those profits. Furthermore, some investments may qualify for special tax incentives, like the Qualified Small Business Stock or QSBS exclusion, which allows investors to exclude up to 100% of their gain on certain qualified stock investments from their taxable income. No matter what type of investment is chosen, it's important to stay informed about applicable taxation rules and regulations in order to maximize savings and profits while minimizing liabilities and risk. So when talking about tax, I would say real estate might just edge it over stocks because there are a lot more options for you to reduce your tax bill. Control. Investing in real estate provides more control than investing in stocks due to the ability for investors to choose their own location, size, and type of property, as well as negotiate for lower prices. With real estate investing, you're purchasing a physical asset that you own, so you can decide exactly how it's utilized. Maybe you want to buy and sell properties for a profit, or maybe you want to build an empire of rentals that pay you each month. Real estate gives you this level of control. In contrast, investing in stocks doesn't offer quite the same type of control as investing in real estate. When investing in stocks, you can't negotiate a lower price like you could with a real estate purchase. Stock investors are also unable to influence the decisions of a particular company. For example, they can't decide where resources are allocated or how profits are reinvested. This lack of control is one of the risks associated with stock investing and can limit returns compared to real estate. Additionally, stock market performance is often affected by external forces, such as economic conditions and national policies that the investor has no control over. So if we're talking about control, I would definitely give this one to real estate. Leverage. Investing in real estate can provide the opportunity to leverage your money and potentially achieve higher returns. By leveraging financial options such as mortgages, you can purchase a larger property with a smaller initial capital investment. This enables investors to maximize their return on investment without having to put all of their own funds into the property. Real estate investments tend to appreciate over time, which can provide additional returns when the property is sold or refinanced. While leveraging in stocks can be more volatile and riskier than real estate investments, it can also offer potential for significant rewards. With stock investments, you are able to buy shares on the market that have potential to increase in value over time. Leveraging stock investments through margin trading can amplify those gains if done correctly. However, it is important to note that leveraging carries with it a greater risk of substantial losses when markets are uncertain or declining. In terms of leverage, real estate wins this because you can take on much more leverage and the underlying asset is more stable. Potential returns. Last, but definitely not least, is the rate of return. Investing in real estate can provide a steady return in the form of rental income. Property owners may find that their income from rent increases over time due to market appreciation or other factors, such as proximity to desirable amenities. Additionally, investing in property located in areas like coastal towns or popular tourist destinations can provide an additional form of income from short-term rentals. On the other hand, stocks can generate returns through dividends, but it usually takes some time before investors begin to see substantial returns on their stock investments. This is because you typically need a large amount of capital invested in dividend stocks to make any worthwhile income. But what about capital gains? It's hard to comment on capital gains, as they can vary greatly depending on where you choose to buy your property or which stock you choose to invest in. So for potential returns, I think it's only fair that this one is left as a draw. Ultimately, the decision of whether to invest in stocks or real estate comes down to personal preference and financial goals. Both investments can offer great potential returns, but come with a different set of risks and rewards. Investors should carefully assess their individual situation, long-term goals, and risk tolerance before making an informed decision. It's important to remember to diversify your portfolio in order to minimize risk and maximize potential rewards. Having a balanced mix of stocks and real estate can provide investors with greater control in managing their wealth, as well as peace of mind, knowing that their investments are diversified across different asset classes. What do you think? Are stocks the best option? Or maybe real estate is better? Let us know in the comments section below. As always, I hope you enjoyed today's video, and I'll see you in the next one.